All right, guys, this is lesson one of the IPDA X algorithmic principle mini-series. Just as a disclaimer, this is a mini-series, so there are a lot of things that I will keep on a surface level. However, what this does is it gives you or it sets the stage for how you guys should be thinking, how you should be studying this stuff, and just trying to make sense of it and blend these concepts together, right? Because of that, that's why we want you to be able to join the actual boot camp where we're able to make these things a lot more clear in terms of understanding and give you the entire and holistic systematic approach. All right, so for this lesson one, we'll be talking about bias, and one of the things when it comes to bias, I think is highly important that we understand the idea of actually profiling the market, right? And what that means is simply understanding the price delivery cycle. And the main two parts of the price delivery cycle are, the consolidation and the expansion, right? So we want to know, is this market consolidating, right? And obviously consolidations, you know, is where this is where price is ultimately accumulating, all right? And the reason that's important is because consolidations ultimately lead to expansions, right? That accumulation, right, at some point will lead to, and actually let me draw this for you guys. That accumulation at some point will lead to an interbank dealing range being created. All right. And you guys actually have the luxury of looking at a live lesson to actually gain a proficient understanding of the entire anatomy of a dealing range, right? And so on the opposite side of that, we have expanding markets. All right. Now, this is also important because with the expanding markets, this is more so, ideally, we'd say that this is where price is trending, right? And there's two parts to this, right? For price is trending, we have to know, is this part of the trend just a reversal, all right, in reference to the current price range, or is this a retracement? All right. Now, and then when I'm talking about reversals, right, I'm going to throw in here continuations, and you guys, once we get to the chart, you'll see why I'm saying that. All right. So profiling the market, consolidations, expansions. Consolidating is where price accumulates, leads to dealing ranges, potentially, and then obviously consolidations will lead to expansions, where we have trending markets, and that those two pieces of that are reversals and retracements. All right. Now, once I understand this, right, and we obviously we get to that, we arrive at that, we understand that current order flow. What I'm going to do is I'm going to define the current price range. All right. And all of this is being done on a higher time frame chart. And I'm talking about quarterly chart, monthly chart, weekly chart, right? And the reason, I mentioned quarterly chart is because markets are delivered in quarterly cycles, right? You have a March contract, you have a June contract, September contract, and a December contract, right? So you want to pay a lot of attention to that quarterly chart, right? And then you start trickling down to your monthly, your weekly, and your daily because it's all fractal, all right? Now, once you understand the current state of order flow, right, and you guys are going to be able to watch a video and gain deeper understanding of that. But once you understand order flow, you define that range, right? One thing that's very key is understanding that within defined ranges, right, meaning we have point A to point B, within defined ranges, this is where buy and sell programs form. All right. So if you think about a defined range, right, price is going to create a premium and a discount. Premiums here, discounts here, right? And that look back function is going to key on the most significant premium array within this range, all right? Or it could be discount array in another scenario, but for the sake of this teaching, we're going to use a premium array, right? So let's imagine that the premium array in this case is a fair value gap, all right? And we're looking at a quarterly chart. Now, we would understand that from a quarterly perspective, right? Price is going to want to trade up into premiums to this premium array, right? And this is where we're going to be anticipating a smart money reversal. Okay. Now, the only way that price can get up here, right, is by, I like to use this analogy, is by trading from first floor, actually, use a different color. The first floor, right, up to the 20th floor, right? Now, why is this analogy important? Because if you think about it, the only way that price gets here is it has to ultimately go up a new flight every step of the way, right? And by me saying new flight, what I'm referencing is the actual draw on liquidity for each interval. And I say interval because this stands true for a quarterly chart, a monthly chart, weekly chart, daily chart, right? It's all fractal, right? And the reason I say that is because if you think about a monthly candle, all right? If this is one monthly candle, well, guess what? There's 4 weekly candles that go into creating this entire monthly candle, right? Now, if we take a weekly candle, well, there's going to be 5 daily candles that go into creating that one weekly candle. All right. And when you understand where the draw of liquidity is, right? So this would be the draw, obviously. Price is attacking previous intervals high. All right. When you understand where the draw of liquidity is, very next thing you do is you start applying power of 3. All right. Now, for the sake of this being a mini series, I'm not going to go as in depth with that. But from that understanding, all right, just understand that market maker models will form in defined ranges. All right. And if I know that this range is defined, I know what the higher time frame order flow is, then I know that this move from point A to point B, right? This is just a retracement. It's important that I know it's a retracement because I know to what extent is this expansion going to last, right? And then once we get the smart money reversal, all right, then I know to what extent is this reversal going to last, right? Meaning that in this case, we probably see price creating a new lower low, all right? So if I take you guys to the chart here, and if we look at, we'll start out on the quarterly chart for Euro USD, right? And looking at this chart, one thing that we can see here is super obvious is that the current state of institutional order flow, right, is bearish, right? And basically what that means is that price is respecting premium arrays, all right? So the current state of order flow is bearish, right? Every time price creates a defined range, there's a high, there's a low, right? The look back function goes and it finds the premium array, right? And then you see a sell program form, right? So from here, we have another defined range, right? Then what happens? Sell program forms, creates a lower low. Another defined range, guess what happens? A sell program forms, right? So if we stop here, here's a defined range, right? Remember, once you have a defined range, right? And at this point, we would already profile the market, right? We'd understand that these movements, right, from this part down is that reversal, right? So we're going to see expansions below that last low, right? More of a low resistant liquidity run. And these movements back into the range are more so those retracements. So as price reaches premium arrays, the odds of us being long start to kind of decrease. All right. So with this defined range, we would understand that this is a retracement. So what I'm going to do with this range is I'm going to take this range, all right? And remember, once we have the range, we're going to go through our PDRA matrix, right? Because the look back function is going to seek out the most significant array, right? Or price point, all right? So in this case, what we have is a mitigation block, right? Mitigation block here and fair value gap, right? Which makes it, even more high probability. Okay. So now that we have that, we would see this as the first floor, as the 20th floor, right? Or the array as a 20th floor, right? Meaning that this up here, right, this price point, we see this as a potential for a smart money reversal. Now think about this. This is a quarterly chart, right? There's a lot of intraday trading to be done if we're sitting here looking at a quarterly chart, all right? So now, because this is a quarterly chart and price needs to run higher from the first floor to the 20th floor. Think about what the draw of liquidity is going to be when you trickle down to a monthly chart. There's a monthly candle, right? It consists of 4 weekly candles. Well, think about what the draw of liquidity is for each weekly candle, right? Each weekly candle consists of 5 daily candles, right? Then once you throw power of 3 into the mix and you start understanding weekly profiles, daily profiles, right? That is when you start to create the right narratives behind price. And one of the things that we do, right, is we once we have all of this stuff aligned, we then move into our protocol for the week, for the month, for the day, and that keeps us in line with that entire systematic approach, right? So for the sake of this just being a mini series, I'm going to stop there. But once again, this is why we want to see you guys in that boot camp so that you can get a more holistic approach and we can really make more sense of this. So hope you guys learned something from this, and I will see you on the next video. Thanks.